Hello, everyone, and welcome to today's webinar, Acquiring and Managing Mortgage Note Portfolio. This is professional real estate investor and mortgage note broker David Campbell, and I'm joined by some fantastic panelists today. Kaaren Hall from uDirect IRA.
Hey, David, how are you?
I'm so happy that you are here, Kaaren. I've been a friend and client of uDirect for a number of years, and it's a real honor to have you on a podcast today.
Well, thank you. It's an honor to be part of this panel, so I'm very excited. What a great topic.
Awesome. And also joining us today is Amy Sayre, the president of August REI, which is a residential loan servicing company. And I have been also a customer of August REI for a number of years. And it's a pleasure to have Amy on our podcast today.
Hi, David. Hi, Kaaren. Thank you for having me.
This is a super, super awesome panel. And so the reason we assembled the three of us on a panel today is when we're working with mortgage note investing, many of our investor clients are using IRA funds. It's one of the most popular investments for IRAs right now, self-directed IRAs. So it's really, in putting your team together, there's the borrower that lives in the property and they pay for that mortgage, and they send the money to the mortgage servicing company. You don't want the borrower to send the money directly to your IRA. You want to send it to the borrower to send it to a company like August REI, who, and Amy, tell me why that is. Why do you want the borrower to send the money to you rather than to an IRA custodian directly?
So we can address the check correctly so it doesn't blow up someone's IRA. That Kaaren has the IRS has many requirements on the check to ensure that it's addressed correctly to the IRA for the benefit of, or FBO, and then the account number or the IRA holder's name.
Yeah, and so maybe I'll address that question to Kaaren as well. Kaaren, does uDirect IRA collect money? Are you a debt collection company?
Well, I think what you're getting at, no, we're not a loan servicing company like Amy's company is. When it's a self-directed IRA, you can only do a few things. You can pick up the payments, but you can't, there are very few things you do because you can't provide services to the plan. So when you have a self-directed IRA, we don't provide loan servicing services. We provide self-directed IRA services. So we'll do the tax reporting and record keeping on your IRA account. But when it comes to actually the servicing of the loan, that's something that we do not do.
Yeah, so it's very important that you get your whole team together. The borrower sends the money to the mortgage servicer, and then if the borrower doesn't pay, then you have the servicing company, which is a debt collection company, that can address the borrower properly and do all the great things that Amy is going to tell you about a little bit later about her company. But that's why we've assembled this team today of speakers, because you do need a team of service providers to help you correctly service your portfolio, and that is one of our big topics today, is not only how to acquire a portfolio, which we're going to talk about, but how to service it, and that's why we have our team together today. So why mortgage notes? Passive income, right? We all want to trade our money for more money. We want our money to go out there and have little children, and then those children have grandchildren, and our income can grow passively. And when you have a mortgage note, it's one of these simplest investments there is, right? It's one of the act of lending, or the concept of lending, is as old as time. And there will always be a need for people to rent money. And if you can rent your money to someone else and they pay you a rental fee on your money or interest on your money, that is very, very simple business plan for success. One of the rules of hassle-free cash flow investing is make the process simpler and you're more likely to succeed. And so what we're talking about today and in all of our hassle-free cash flow investing presentations is how do you invest less time and less complexity so that your return on investment can go up? How do we make the process simpler so that you can be more successful as an investor? Today is pretty appropriate for this slide. The stock market had another slide, and if you've been a follower of my newsletter, my blog, you can see that I've been saying for a long time, that the market was at a high, and I called a high somewhere north of 18,000 Dow Jones, and we continue to slide from that number, and it's very volatile, right? There's a lot of emotions. People check their stock market in real time on their smartphone, and there's a lot of emotions behind how their portfolio is doing, and I want to get off that emotional roller coaster. And not only do I want to get off the volatility and the substantial risk of being invested in stocks and mutual funds, when you do the math and you see how well mortgage notes perform relative to the stock market, the magic of mortgage notes is the ability for your interest to compound. Meaning, if you have $100 invested in a mortgage note, the beginning of the next year, you can reinvest $110. And then the next year, you're not going to just earn $10 of profit. You're going to earn $10 of profit on your principal, plus you're going to earn $1 of profit on the interest. And so that's where your principal has children, your children have grandchildren, and that interest has great-grandchildren. And the compounding effect of interest is one of the most profound forces in the universe, is the compounding effect of interest. And when you're investing in the stock market, you really don't get that same level of compounding. And that's why a compounded mortgage note at 10% interest beats any 20-year period in the stock market. You pick any start and stop over a 20-year period in the S&P and the Dow Jones, and mortgage notes will outperform that 20-year period because of compounding, right? So make sure when you're doing your spreadsheet, you're doing it on a compounded effect. So what is a mortgage note? We are going to say the words mortgage note, but it means lots of things that are basically the same. So a mortgage note is two things. It's number one, a promise to pay, and number two, it's a security of that promise by a piece of real estate. We can call mortgage notes note and deed of trust. We can call it a hard money loan. We can call it private lending. We can call it seller financing. We can call it note buying. There's all kinds of words that mean fundamentally the same thing, which is someone promises to pay you principal and interest, and they back that promise up with real estate. That is fundamentally a mortgage note. Technically, there are very different nuances between a mortgage note and a deed of trust, but we're going to use those words interchangeably today. And when we talk about mortgage notes, but they are different. A deed of trust and a mortgage note are technically different, but they're fundamentally the same type of investment. Why do I like mortgage notes? It's very simple. Someone promises to pay you your money plus an interest rate. That's very simple. A note is a guarantee of repayment. But you say, well, how good is that guarantee? Right? Well, the guarantee is secured by a piece of real estate. So if the borrower doesn't pay you, you get the piece of real estate they pledged as collateral. So we want to be profitable whether we get repaid, and we want to be profitable if we're not repaid. And if you can just use that as your core underwriting criteria, you're going to do well in mortgage investing. Say, will I be profitable if I'm repaid? Will I be profitable if I'm not repaid? And if the answer is yes to both those questions, then you're on the right track for investing. So we've created a system of investing in mortgage notes that makes the process hassle-free. There's lots of ways that you can make money as a mortgage note investor. The formula that we've created is specifically, how do we make the process simpler? How do we set our clients up for success by making the process simple? How do we come up with a system of rules that will make your success more likely? And so here are some of those things. Number one, we always want to invest in lender-friendly states like Texas. So to me, that means we want to invest in deeds of trust, not mortgages. So some states use a deed of trust as a security instrument. Some states use mortgages. I don't like mortgages. I do like deeds of trust. A deed of trust means if they don't pay you, the trustee goes to the foreclosure sale, and after proper notice, they can sell the property. A mortgage means if the borrower doesn't pay you, you have to file a lawsuit. You have to file an action in court to force the courts to sell the property. Mortgages are just a little bit more expensive to enforce, a little bit slower to enforce, than deeds of trust, which is why I really like states that use deeds of trust. Texas is my favorite state for lending in. We use single-family homes as collateral for the notes, and we want a minimum property value of $75,000 securing our notes. And the reason we like that minimum property value is there is a fixed cost of foreclosure and a fixed hassle of foreclosure. It's highly unlikely that we're going to foreclose, but we are going to talk a lot about foreclosure today because 98% of the time, statistically, you're going to get repaid. But 2% of the time, statistically, in the state of Texas, you're going to have a foreclosure. And so 98% of our presentation would be really boring, right? Hey, buy a mortgage note and you're going to get paid as agreed. But what about that 2%? And that is what we're going to be talking a lot about today, is what happens if that 2% happens and you aren't repaid and you do have to foreclose. What are some things that set you up for success if you fall in that 2% category? One thing that you can do is to build a portfolio. If you have just one mortgage note, you might fall into your one note, might fall into that 2% category that goes into default and you've got one foreclosure. If you've got 100 mortgage notes, then it's likely that you're going to have most of your portfolio do well and some of your notes are going to go to foreclosure. But if we loaned properly with less than 75% loan to value, then you're going to be profitable even in the case of foreclosure. And so I don't want to be afraid of foreclosure. If you're looking at a mortgage note investment opportunity and you find yourself afraid of foreclosure, then you're doing it wrong, right? So if you say, I don't want to take title of this property, you're doing it wrong. Okay, here we go. Mortgage note payments should be equivalent to rent, right? That's important for two reasons. Number one, we're charging a high rate of interest to our borrowers, but we don't want to take advantage of our borrowers. And so we want to create lending situations where the borrower says, I could rent this property for $1,000 a month, or I could pay a high rate of interest and own this property for $1,000 a month. And so we want to create win-win situations for our borrowers. We also want to create loans that are very affordable for our borrowers. Even though it's a high rate of interest, we still want to create opportunities to set our borrowers up for success. We talk a lot about foreclosure and how that is a success for the lender, but really we do want our borrowers to succeed. We're buying this for income. We're not using this loan process to own a property. But if you do wind up owning the property, you're going to do fine as an investor. That's our part of our strategy. We also want to have lender title insurance in place, protecting your loan interest, making sure that your lien is the priority that you think it is, which is first position. We advocate first position liens. There's a lot of people that are selling discounted or non-performing second liens out there. I'm sure you can make money in that, but I really question suitability. I personally own lots of second mortgage notes, but it fits into a certain suitability part of my portfolio. But the vast majority of what I would like to do is own first position notes because of the security and the income and the predictability and the likelihood of success owning first position notes. So if you're looking at second mortgage notes or you're looking at non-performing second notes, really ask yourself, not only does this make financial sense, but does this make financial sense for you? Is it suitable for you and your economic circumstance? The other thing that I strongly advocate is professional mortgage servicing. And we're going to hear a lot from Amy Sayer at August REI and hear why we need a professional mortgage note servicer and what they do for us and how incredibly affordable that service is. And if we're setting our notes up according to Hassle-Free Cashflow rules, that mortgage servicing is paid for by the borrower. And so it's not impacting our investment yield as an investor at all. The next thing that is important is that the note's professionally underwritten, right? If you are a professional licensed mortgage loan originator, congratulations, that's awesome. Most mortgage note investors are not. Most mortgage note investors have a job or they're using their IRA and they're just normal folks who want to get a good interest rate on their money. In this particular instance, you may not have the professional skills to underwrite the note to determine, hey, does this really make sense? And am I collecting the right documentation to see if it makes sense? We want to outsource that to a licensed professional who can, number one, collect the due diligence information, stick it in a folder so that you can review it and make an educated decision. And number two, they're putting their seal of approval on that note. So if there's ever a case where the borrower claims the note was unaffordable and that they were taken advantage of and given a high cost mortgage that they couldn't afford, we've got a third party to put their seal on the underwriting to say, no, this, at the time of application, this loan was affordable by the borrower. And here's the supporting documentation, and here's my seal of approval saying, yes, we think this is an affordable mortgage. The other thing in creating a hassle-free cash flow mortgage note, we want our notes to be amortized. The reason we want that amortization is it increases the likelihood of success for the investor, that the borrower is contributing equity payments to that loan. And as that equity builds in the loan, it's less and less and less likely that that loan will go to default, and it gives the mortgage note servicer and the investor more and more leverage with that client because of the equity, right? If a borrower is at 120% loan to value, they call the mortgage note servicer and say, well, let's negotiate, right? Because you don't want the property back because you're over leveraged. Flip that table around and say, hey, it's 50% loan to value. The borrower knows if they don't pay, they're going to lose their home and they're going to lose all the equity inside of that property. It shifts the power, it shifts the negotiating strength to the mortgage servicer and to the lender, which is where we want it. So why I love Texas? Number one, it's no income tax. So if you're in a state that is a no tax state like Nevada, and you're owning mortgage notes in a state that has no income tax, that's awesome. No state income tax means that the state is growing from a population standpoint. It's very business friendly. It means also that your borrowers have more money, right? So when you're looking at apples to apples, the borrower in Texas, they get to keep more of their money than a borrower, say, in California, because they're not paying income tax. They can use that money to service your mortgage, which is what you want. Texas is a very low foreclosure rate. Even in the Great Recession, Texas foreclosure rate was very low. Lender laws in Texas are very friendly. You can foreclose in about 120 days. And the cost is usually $1,000 or less to foreclose on a deed of trust, a non-contested deed of trust in the state of Texas. We've got a great ebook on our site that I'll introduce you later to, which talks about the foreclosure process in the state of Texas. Again, less than 2% of mortgage notes in Texas are going into foreclosure, but it's important if you wind up in that situation that you understand the process. The laws are landlord friendly. So ultimately, one way to acquire rental properties is if you loan and you get the property back, well, you could resell it for cash. You could resell it on seller financing and get your note to perform again. Or you just bought yourself a rental property for 75 cents on the dollar. That's not so bad. And then you can use the landlord-friendly laws of Texas to help you manage be successful as a landlord. We like, as I said, the cost to own and the cost to rent to be comparable, which sets our borrowers up for success. It also means we have a very strong supply of lending opportunities, because in some states, the cost to own, especially at a high interest rate, would be so much higher than the cost to rent that there would be very few borrowers. I also like in Texas, because of the way the flow of capital, the interest rates tend to be higher in Texas than in, say, the San Francisco Bay Area, which is where I am today. Also, I love this, that in Texas, the destructive acts of a borrower are not only subject them to civil liability, because in Texas you may have the right to a deficiency judgment against your borrower, but they're potentially criminal. So if the borrower gets mad because you're foreclosing on them and they go through the house with an axe and they beat up the whole house just to be angry at the lender, not only have they created civil liability that could extend beyond the cost of the foreclosure, but it might actually be a criminal act as well. So we love that, because what that means is borrowers usually don't smash up the property on the way out, right? Because number one, they don't want to pay for it. And then number two, they don't want to go to jail. So we love Texas as a state. This chart here from the Dallas Federal Reserve shows that the Texas foreclosure rate is usually less than the national average. There was a period in the 80s, the savings and loan crisis, where Texas had some slightly higher than normal foreclosure rates. But if you look, people talk a lot about foreclosures, and foreclosures make the news a lot, but other than the Great Recession that we just had, foreclosures are relatively rare. And even in Texas during the Great Recession, foreclosures were relatively rare. Here's a chart updated from 2012 showing where the hotspots of foreclosure are, and the parts of the country that had minimal foreclosures. And Texas was one. Now, I'm not saying that you got to buy mortgage in Texas, but these are the criteria that I would encourage you to look at when you're deciding which market it makes sense for you to lend in. When we're putting together a mortgage note, any bank is going to look at primarily three criteria: the borrower's income, the equity in the property securing their loan, and the borrower's credit. Now, if the borrower was perfect, they had perfect income, perfect equity, and perfect credit, there is no opportunity for a private lender. That opportunity is going to go to Wells Fargo. The borrower is going to borrow the money at 4 to 5%, and it is what it is. That note will never circulate in the private investor market. We are looking at doing common sense lending. We want the borrower to have good income. We want the borrower's debt to income ratio to make sense. We want to document that income, that they can afford the payment. We want the borrower to have a lot of equity in the property so that if they don't pay us back, we get the property with the equity in it, and that equity is the source of our repayment and possibly even a profit, right? The reason the borrower in our hassle-free cash flow mortgage investing model, the reason the borrower is paying a high interest rate is their credit. Either their credit is weak, or very often they have no credit at all. You pull their FICO and nothing. They've never financed a stick of gum, so they can't go get a bank loan. They have to rely on private financing. A significant portion of the borrowers that are utilizing our services are here as permanent resident aliens. So they have the legal right to live and work here because they don't have a social security number. They have a tax ID number that starts with 9, but they don't have a social security number, which means they can't go get the cheap financing from Bank of America, Wells Fargo, Fannie Mae, Freddie Mac. So we're filling a great need in the marketplace, which is to provide financing for people who make common sense. They make good money, they've got a down payment, but their credit is not established, so we can actually help them establish credit. We actually give them a chance to own. They're paying their mortgage down pretty aggressively on a 15-year amortization, and Amy at August REI will talk about that her company actually can report to credit bureaus, which helps our borrowers establish conventional credit, and eventually they can refinance and pay you off as an investor, which is good, right? Most loans are paid off in 7 to 8 years anyway because the borrower refinances or they sell the home and the home is paid off at that point. So we really want to set our borrowers up for success. It's win-win. We give them a chance to own instead of rent, and it's at the same price. Number 2, we get a chance for them to rebuild their credit. Number 3, eventually they own their home free and clear. In fact, in 15 years, they own their home free and clear. And the investor, they win because you get a 10% yield that is secured by real estate. It's a pretty awesome win-win formula. Here's a typical note sample. Here's an interesting one. This particular borrower was perfect in every single way. 712 FICO score, great income, great debt to income ratio, 5-year job history at the same job. The only thing wrong with this borrower's loan application is they didn't have a social security number. They had a tax ID number. So the only thing preventing them from getting a 5% interest rate or 4% interest rate from Bank of America was they didn't have their social. They had a green card instead of a social security number. So this was a great opportunity for us to help a family get the opportunity to own a piece of the American dream. And I'm sure they wrote home to their families in the country that they came from and said, look, I've made it. I'm a success. I have a job. I've got own a home in America. And the chances of them defaulting on that American dream are probably lower, right? And the biggest thing is because they have so much money. They have a significant down payment in this particular property. It's a small part of our business, but we also arrange construction loans, primarily in Texas and Georgia, but that is definitely a small part of our portfolio. So if you do have an interest not only in owning seller finance notes, but doing shorter term construction loans, we can help you achieve a 10% interest rate with construction loans as well. The note buying process is pretty simple, whether you're buying from us or from any company. I encourage you to look at this particular process. Number one, get a snapshot of the deal, right? We put out an executive summary via email. Here's the executive summary, and in two minutes, can you say, yeah, this sounds pretty good. And then on a first look, first glance, this would fit. Then you ask some preliminary questions. Hey, I've got a question about this, or maybe there's no questions at all based on the executive summary. The next important thing, and I encourage you to do this in all of your investing, before you invest a lot of time and money and hassle into a deal, I encourage you to get control of the deal, because I see this happen over and over and over again, where a borrower, they ask a bunch of questions, they get access to the due diligence material, they spend a week, 2 weeks reviewing every single document, and then they call and say, okay, that deal looks good, I want to do it. And I say, so sorry, but it sold. It sold a week ago. You just spent the last week of your life looking at a deal that you didn't have control over. So whether it's property or a mortgage note, always get control over the deal first, then do your due diligence, right? In our particular case, we can provide access to a Google Drive, which has all of the borrower's income information in their very complete. It's probably hundreds of pages of information for you to potentially review. Then, once you've reviewed the information, you make an investment. That process is fairly simple, whether you're investing cash or IRA funds. Our team is here to make the process hassle-free for you. And then to make it even more hassle-free and set you up for success is having professional mortgage note servicing help you on a monthly basis so that you can be doing whatever you want in life. And if your borrower pays late, you know someone else is doing that auto dialer caller and sending them a notice and doing the compliance that you would need to do if you eventually have to foreclose, right? You want to outsource that to a professional. And the cost is extremely low, and it's paid for by the borrower. It's like free property management for your rental property. Who wouldn't like that? So I would like to talk with Kaaren about why mortgage note investing makes sense in your IRA. I would say probably 50% of the capital that we work with in our private lenders is coming from self-directed IRA funds, right? You want to get that money out of mutual funds, out of the stock market. That's a very high risk, low yield, in my opinion, and get that money self-directed. And my personal favorite investment for self-directed IRA funds is mortgage notes. I'm a professional real estate investor. I love owning property. I own all of my property outside of my IRA, and I own lots and lots of mortgage notes in my IRA. I love owning notes in my IRA. And we didn't talk about it on this call today, but we actually, as a company, are one of the few companies that work with mortgage note fractions, meaning even if you had, say, $22,000.11 in your IRA, we can potentially help you invest $22,000.11 in a mortgage note so that you don't have any waste, you don't have any idle funds in your IRA account, because we can help you apply that to owning a fraction of a mortgage note. If you've got a question about fractions, we can talk about that one-on-one. And ladies and gentlemen, let's welcome one of my favorite people and the custodian of my personal IRA. We've been doing business with uDirect for years. We send dozens and dozens and dozens of clients to uDirect who report fantastic customer service experience, and I think they have the best pricing in the industry. Kaaren Hall from uDirect IRA.
David, thank you so much. You're just talking about risk and investments and so forth. It's funny, the Department of Labor has recently been saying, well, hey, those alternative assets, they're probably too risky. And then then the stock market, it was the day after, plummets 1,000 points. So when you think about, you've got retirement money, what are you going to do with it? And Are you more at risk in the stock market or investing in something that you know and understand, like you've been describing mortgage notes? I mean, you're certainly the expert in mortgage notes. So you need to decide, where do you have the control, where's the risk, and what do you feel good with? Now, at uDirect IRA Services, we don't tell you what to invest in, and we don't endorse any particular investment, and we don't give tax and legal advice. Okay, so that said, what we do is help you self-direct your IRA and understand the process and hold your hand through everything, from opening the account to passing it on to your heirs. I mean, everything in between. So with that said, a lot of our account holders do invest in notes. It's a very popular asset class right now. I mean, all different asset classes will have their peaks and valleys. You can imagine when there are all the REOs, people were investing in houses, and now there are fewer REOs, and notes has really come into prominence as an IRA investment. So we can push forward to the other slide and say that when it comes to a self-directed IRA, what's the difference, right? And it's funny because people will look at our website and say, well, where does it say the self-directed IRA? I'm looking for that. Well, you can self-direct a traditional, a Roth, a SEP, a simple, a spousal, an inherited IRA. What makes it self-directed, the difference, is the asset that the account can invest in. So if you've got a typical IRA and it's with a financial advisor, and you say, hey, I want to put mortgage notes in my IRA, well, they may say you can't do it, or they may say we can't help you because they don't sell or help you with that kind of an asset. The reason you use a self-directed IRA is because we do allow alternative assets. That's the main difference. So it can be notes, it can be real estate directly, it can be private stock, tax liens, so many different things. So what's the difference? The difference is the asset that the plan can invest in. All right, so let's go on. Now, the IRS, it's great that they don't tell us really, like, here's what you have to do. They say, here's what you can't do, and they leave everything else up for interpretation. So the IRS says that your IRA is not going to invest in life insurance contracts, okay? Your IRA is not going to invest in collectibles. So no collectible coins, art collections, fine wine collections, artworks. Those are the things that are not going to go in your self-directed IRA. On to the next slide. But really what you can invest your self-directed IRA in is anything except those two things for the most part. There are exceptions. I got this call just today. Someone called me and they were very excited to self-direct their IRA. They had a great investment. And I said, okay, well, where is your money today? And they said, well, my money is with my current employer. So we had a little conversation about that. If your funds are with your current employer in that 401k, maybe it's a 403b, maybe it's a 457 plan, an employer plan, you will probably not be allowed to self-direct those funds today if it's an employer plan. You pretty much have to wait until you leave the company before you can move that money. But there is a possible exception. You can go to that custodian and say that you want to have an in-service transfer. You're in service, you're working there, and you want to move your money into a self-directed IRA. And there are circumstances when you can do that. Like, for example, if you hit 59 and a half, or maybe your company was gobbled up by another company and you have some money from the previous company. Sometimes there are cases when an in-service transfer is allowed, so it's worth asking for. All right, going on to the next slide here.
Kaaren, I would say at least once a week I meet with an investor in a investment strategy consultation, and they show me that they've got enough assets in their company 401k plan that if it were invested in mortgage notes, it would far exceed their personal income or personal
Wow.
expense. So they're out of the rat race, but because they're working, they've got to leave their 401k exposed to the risks of the stock market. And so it's ironic that many investors, the smartest financial decision that they could make is to quit their job. It allows them access to their 401k. They can roll it over to self-directed, use that self-directed account to buy first position mortgage notes that are producing enough income to last them for eternity. And then if they want to go back and get a job, they can go do that, right? Nothing says they have to stay unemployed forever. But by the very act of showing up to work every day and leaving their IRA exposed to the market, it's keeping them in the rat race. It's a double irony.
And then here you are busy doing your job when you find out that the stock market plummeted, you can feel kind of powerless. It's funny because you can't typically, usually it's discouraged for employers to offer their employees a self-directed option because it's considered to be too risky, but the stock market isn't. So yeah, it's ironic.
It's terrible math. Like, for example, let's say there was someone making $100,000 a year and they had $1 million retirement account, and the stock market goes down 10%. That's an entire year's wages that they lost in that stock market correction. And maybe they're only contributing to their IRA, $20,000 a year, if that's a pretty aggressive, contribution program. But even if they were, aggressively, let's say $10,000 a year, right? It's going to take them 10 years of working to replace those losses that they had in their IRA. And the ability to get control of those assets, get out of the volatility of the stock market, get them into an asset like mortgage notes that are income producing, that are well protected by something real, is a really powerful opportunity for those people who are paying attention.
Yeah, and that's the great thing about the self-directed IRA is it gives you a choice. You don't have to just do one thing. You have the choice to do other things and invest outside the stock market. Now, there are definitely rules about self-directing your IRA, and before you do that, call us here. We'll go through them with you. But basically, if you go to irs.gov, their website, and you look up Pub 590, you're going to see some of the rules about IRAs. And you don't borrow money from the IRA account. You don't sell any assets to your self-directed IRA that you already own. Your IRA is not security for a loan. And you don't use your IRA to buy property or any kind of an asset for personal use, present or future. So that's some of the rules. But if you want to press on to the next slide, we can go on to the next slide. I'm hearing a little background noise there. Some people are disallowed to your IRA. And it's important to know that the disqualified people are your lineal ascendants and descendants, plus anybody who's offering services to the plan, right? So your IRA is not going to lend money, for example, to your parents. People will call when school starts and say, hey, I'd like my IRA to lend money to my son so he can go to college. Well, your son is a disallowed person, so it would be a prohibited transaction for your IRA to lend money to your son, so it's disallowed. Okay, so the next slide is going to cover people who are allowed. The qualified people are the people who are out to the side on your family tree, like your nieces and nephews, brothers and sisters, aunts and uncles, and so forth. So your IRA can make a loan to your brother, but your IRA is not going to make a loan to your dad. See, it's interesting. So you need to understand who's in and who's out in the self-directed IRA game. So on to the next slide, where we talk about really how this all kind of fits together. And it's a game of keep away. And if you're going to play a game, you need to know the rules to win. And that's what we want to help you do. We want to help you understand the self-directed IRA rules so that you play to win. So neither you nor anyone who's disqualified can benefit from the IRA today. IRAs, they're all about later. It's about retirement benefit only. It's about investment purposes only. So make sure everything you do with your self-directed IRA is an investment and that you're not receiving any benefit. Number two, you're not going to buy, sell, or exchange property between the IRA and someone who's disqualified. Now, you can transfer upon death, but while you're alive, you've got warm hands. You're not going to move the asset from your IRA to a disallowed person. And number three, one of those disallowed people, remember they're your ascendants, your parents and grandparents, you and your spouse, and then your descendants. None of those people can provide goods, services, or facilities to the plan. And when we talk to Amy in a minute, we'll talk about why it's so important to have a loan servicer, because you cannot fully service your own IRA-owned asset because then you're providing services to the plan. What if your IRA lends money on a trust deed and you need to foreclose? You can't go in and be the person that does the foreclosure work on your own IRA-owned asset because then you're providing services to the plan and it's a prohibited transaction. That's why a company like Amy's is so valuable. All right, going on to the next slide. Understanding the structure is also part of understanding the rules of the game so that you can play to win, right? So there's you on the one hand, then there's your IRA on the other hand. When your self-directed IRA invests, it's not you investing, It's your IRA account. You don't sign except as read and approved. We sign on behalf of your IRA. And then there's uDirect IRA Services. When I founded the company in 2009, we enlisted the services of a trust company custodian to handle our clients' funds. And so uDirect IRA Services is the point of contact from the beginning of the account all the way through, and we use a trust company custodian to hold the money. And their employees are bonded and insured. They get audited all the time. So these are the players in the game, and it's important to know that so that you play to win. All right, so going on to the next slide. There are different kinds of accounts that can be self-directed. You hear self-directed IRA. Well, there are 6 kinds of IRAs, but you can also technically self-direct these employer plans. But like I mentioned, a lot of the employers find it too risky because they have a fiduciary duty to their employees, and they find alternative assets. They think they're too risky, so they don't do it. We offer the individual K, though, the solo K, or it's a 401K for a self-employed person who has no full-time employees in any of the companies that they own. Maybe they own 15 companies. If they have one full-time employee in any one of those companies, they don't qualify for the solo K. But a lot of people who are self-employed, who are like realtors, for example, who don't hire people, they qualify for the solo K with lots of bells and whistles. But other kinds of plans can be self-directed as well. A Coverdell, also called an ESA, or Education Savings Account, that can be self-directed. Same as an HSA, or Health Savings Account. So those are things to discuss with your financial advisor or your insurance agent to talk about what these kinds of plans are. So these are all the different kinds of plans that can be self-directed.
And Kaaren, you were mentioning why employers don't allow self-direction, and the employer doesn't really have your financial best interest at heart in terms of your IRA plan, right? IBM had this great marketing campaign that said, they didn't say, we're the best, IBM's the best. Their marketing campaign says, no one ever got fired for purchasing IBM. And so they're saying, like, if you're running an employer's retirement program, if the employer says, well, we're going to allow our employees to self-direct, or we can allow them to buy Wall Street. Well, no one ever got fired for allowing their employees to buy Wall Street. But if we let our employees make their own decisions and they make a dumb decision, then they might be upset with their employer-managed plan. And so,
yeah, well said.
Yeah, so I really encourage our investors to say, whose money is it? Like, it's not your employer's money, it's your money. So you get to make the decision. I love the name of your company. You direct your investments. So don't let your employer say you can't buy the things that you want to invest in if the IRS will let you do it. Figure out a way to how to get your money self-directed. Even if you self-direct your assets and go buy the exact same thing that you own now, you're doing it because you've made a choice to do it, and you think it's the best thing for you based on market conditions and your experience, et cetera.
Right, and you've got the freedom, and you've got the freedom of choice, and so you can exercise it if you find the kind of assets that you love, And so how do you do it? I mean, people always say, okay, Kaaren, break it down for me. So I say it's a 3-step process. Open, fund, invest, right? Open an account. You give us some paperwork. We have a $50 setup fee. The second thing you're going to do is fund that account. You're going to put money into it by making a contribution. You've got contribution limits. You want to talk to your CPA about how much you can put in. You can do an IRA to IRA transfer where you fill out our transfer form. You sign it. You give it to us and we sign it. We send it to your current custodian and then the money gets transferred, right? Or you can do a rollover of a previous employer's plan where you go to that previous employer, you fill out their paperwork, and then it takes a couple weeks. Now, again, with a transfer and rollover, it does take about 2 weeks for those other custodians to move the money over. So we're waiting for a third party to do their job to get your account funded most of the time. But get the account open, get the money into it, and then tell us what you want to invest. Open, fund, invest. To invest, you give us a direction letter. It's a 1-page form. You give us the supporting documentation, which in the case of what we're talking about today would be a trust deed or whatever it may be. We review it, and we put it through compliance review, fund it, and then now you've got the opportunity for that investment to start growing and paying your IRA back the dividends. And when it does, when you start to get those dividends, perhaps they're going to come through a note servicing company like we're going to talk about in a minute. But when they come back in, they're tax-free in a Roth and tax-deferred in a different kind of account. And that just really helps you build for retirement. It's a powerful thing.
And Kaaren, a lot of investors that I talk to, they delay making the decision to self-direct, and once they're self-directed, they delay making an investment with their self-directed IRA funds because they're intimidated by the paperwork process, the logistics. And I just want to say that our company is designed to help our clients make the experience hassle-free, that you don't have to be an expert in paperwork in order to get this done. We can really and truly make the process hassle-free. As you know, we do a lot of the paperwork for our clients and then email it directly to uDirect with a copy to the client so that it's getting done very efficiently and also transparent to the client as well.
And we have transaction coordinators and funding coordinators who are going to work with you one-on-one. If you've got questions, we're here with answers. So we're really going to hold your hand every step through that process so that if you've got questions, they can all be addressed. So on to our next slide here. Oh, there we go. This is how, if you've got questions about self-directing your IRA, send me an email. I'd be happy to take a look at them and review them, because sometimes it may be more complicated than it sounds, or maybe it's simpler than you think. So it's worth taking a look at. You can email me at khall, Khall, at the letter U, uDirectIRA.com. Remember to put the IRA in there. So it's uDirectIRA.com, and that's our website too, uDirectIRA.com, with so many resources and really going deep on a lot of the principles that we've been talking about today. If you want to know more, Pub 590, you can find the link to it there. If you want to know more about different aspects of self-directed IRA investing, you're going to find that on our website, as well as the applications to get started.
And there are more than one self-directed IRA custodians out there in the marketplace. And the biggest compliment that I can pay to uDirect is that in a free market, I've chosen to keep my personal IRA and my wife's personal IRA at uDirect because they provide great service at a great price. And I'm free to go anywhere I want with my IRA, but I've done the research and I've personally felt that uDirect's the best company for my personal needs. And so, number one, I encourage everyone to self-direct, regardless of which custodian you choose. But if you haven't chosen a custodian or you're looking at comparing pricing or services, definitely check out uDirect. Very good company to work with.
Thank you so much, David, and thanks so much for letting me be a guest on your event today. Much appreciated.
Yeah, you've got a lot of awesome stuff to share with us, and this is probably the most important information you're going to learn today. Probably not the most exhilaratingly exciting information that you wanted to know. And this next part of the presentation is really to show why you don't want to do this yourself, right? There's going to be a lot of valuable information that's about to be presented. And this is really awesome stuff for you to know, not necessarily to master, but to know that it's happening in the background for your benefit. And so let's welcome to the call one of the most intelligent women I know on the subject of mortgage note servicing. Amy, are you there with us?
I am. Thank you for that introduction, David.
Awesome.
So, talking about residential mortgage loan servicing, why you need it, how it benefits you. It's not, definitely, as David said, not the most exciting topic, but it takes care of the details and gets money to you. So it's an important detail.
So basically, just to put it in simple terms, the borrower pays you and you pay the investor, whether the investor is an IRA or not. And so by acting as that middle person, that escrow service, so to speak, you handle the tax reporting, the debt collection, and the compliance work for the client. Is that a pretty fair statement of your services?
That's absolutely correct.
Awesome. And you do note servicing in all 50 states?
Not all 50. Quite a few of them, but not all 50, no.
Awesome. And the core market, one of the reasons I found August REI is their core market is the state of Texas, which is my favorite state to lend in. And they do a fantastic job servicing our mortgage notes in Texas. So what's the secret to your success? How do you do it, Amy?
Customer service. I definitely is our ability that we reach out and call the borrowers, and we're following up if there's a payment not coming in, finding out why it's not coming in, how we can, get the payment coming in, and talk to them and set up a plan, make plans with them. The frequent touch and contact is definitely the key to our success.
Yeah, and you get a lot of transparency into mortgage notes, and the mortgage notes that you're servicing are primarily privately held, not bank held. Is that correct?
Correct. They are all privately held.
Yeah, and do most borrowers pay?
Yes, most borrowers definitely pay.
Yeah,
We're underneath IRA.
We talk about foreclosures, which is the thing that scares most people away from doing notes or mortgage notes. But we were looking at nationwide averages and state averages. But what's a portfolio average for you at August REI, specifically in private mortgages, which are probably higher risk because they're privately funded. But across your portfolio, which is very significant, what's the performance look like?
I thought you'd ask that question, so I did look actually before we started, and our default rate right now is at 0.64% of default. So, 99.4 or 3.7 are paying. So that's anything that's exceeding 45 days.
That is fantastic. Yeah. And so I experienced that with my own portfolio of notes, but a lot of investors are reluctant to believe that because they think if the interest rate's high and the borrower's credit is weak, then they're going to not pay. But the consequence of them not paying is, number one, they don't have a home to live in. And number two, they lose their down payment equity. So most borrowers do pay. I kind of think that's the takeaway.
Most borrowers do pay. It's the few and far in between. We occasionally, see a slow pay, but the slow pay is just a late fee that's being collected and passed through to the lender.
Yeah,
it's not a bad thing.
I love slow pay because slow pay means my interest rate has gone up. So if the borrower wants to pay me 30 days late all the time, I would love that because I make more interest.
Absolutely. We have a lot of people who pay on time, though, so I'm sorry about that. We're pretty good at getting paid.
Yeah, that's good. That's good. Tell us about escrow accounts.
Well, an escrow account is that we pay, the taxes and the insurance out of the escrow account. And just a second. It pays the taxes and insurance, and since taxes go on your mortgage, if we don't have them paid or the borrower is holding their own escrow and failed to pay them, they would move into priority ahead of the note. So we make sure those are getting paid. We hold those, we pay those, and we also make sure the property is insured because we are listed as an additional interested party on the insurance, and we're paying the insurance premiums when they come up to ensure if there's catastrophic loss that the loan is paid off.
Yeah, and if you ever thought about servicing your own loan, hopefully this one bullet point alone will convince you to hire a professional because the compliance requirements for handling an escrow account, handling the borrower's insurance and tax payments, it's a huge amount of responsibility.
It is. We're specifically licensed for that.
Mm-hmm. So tell us about insurance, right? We talked about title insurance earlier, which ensures that the lien is properly recorded in the priority position that the investor thinks it is, which is hopefully first position lien. But then there's casualty insurance, which the borrower pays for. Unlike when you're a landlord, the landlord pays for insurance. When you are a borrower, you own a home and you there have to pay the insurance. But that insurance is for the benefit of the lender. So tell me about insurance, how it relates to mortgage loan investing and how your company works with the insurance companies.
Well, the borrower is supposed to be bringing a one-year policy to closing, and we ensure that we receive that and then verify that the mortgagee clauses are correct, that the lost payee or the mortgagee is listed as the lender, or their self-directed IRA. So it would be, for example, uDirect, FBO for the benefit of, and then the IRA name or the account number that's listed on there. And then we're listed as an interested party, so in case, for example, the insurance company goes by and does an inspection and sees branches on the roof, that they're not canceling the policy and just notifying the borrower, and you're not aware that the policy's been canceled on the property. So if a hailstorm rolls through Texas and takes their roof off, that it's just not a house sitting there without a roof.
So if there is some type of an insurance claim or event, as the interested party mortgage lender, you're notified. Is that correct?
You are notified. The check will be mailed to a borrower in the case of a loss claim or paying out on, and then they'll bring the check in to us, and we will make sure that we're seeing receipts. If it's a substantial claim that exceeds $5,000, then we actually hold them and release the funds as we receive invoices to pay out on them. So we're managing it to ensure that the work's done and that it's not just, for example, possibly paying off some medical bills that they have and the house is not being repaired. Because we want to ensure that the house or the property is well taken care of.
So if there's a fire and the house burns down, who does the insurance company write the check to?
They write the check to all parties listed. So it'll be written out to the borrower, to the mortgagee, which would be the lender or the note holder, and also the interested party. It will also list August REI as we're listed on there. And then we will get the signatures on this. And we did have a house that had a fire. Nobody was hurt, thankfully, but it took out the kitchen, the living room, and half of the second story. And we did hold the check on that. We go out and we do inspections on the property. We had a contractor who would go out and do the inspections, and we'd release funds as it was done based on what the insurance claim listed for the repairs. We ensured that the repairs were made as to the 26 pages of insurance documents of what was to be repaired, and then we'd release funds on it to ensure it was done.
Yeah, that's awesome. So that insurance is there to protect the lender, and that the insurance money winds up into the collateral, which is for the benefit of the lender. And it's awesome that your company helps make that service. So tell us about holding escrow.
Well, I put that in there because we'll have, from time to time, we'll have lenders who are like, well, my borrower wants to hold their own escrow. And it's under regulation. It's Reg Z, and it's the borrower has to own more than 20% of the equity in the house in 5 years before they could even do away with the escrow account. It's mandatory that they have that escrow account in place. It's not an option for them to hold it when the interest rate is 1.5 points higher than the LIBOR rate. And I haven't seen any owner finance loans that are actually lower than that. So all loans that we hold need to have an escrow on them.
So this is another way to say this is lender impounds, that the borrower is required to pay principal, interest, taxes, and insurance. So they have to pay an impounded payment every month. You hold the impounded tax insurance money for them, and it's a requirement of the loan.
Yes, it is.
Yeah, awesome. What's RESPA? Why is it important?
Well, it's a real estate settlement procedure. It's requires for servicing, it's paperwork basically, and it's paperwork that can get tricky. And if you're self-servicing your note, you don't want to be stuck there not meeting the requirements or having incorrect paperwork. If someone audited or a borrower said, I think they've handled it incorrectly, I mean, you want someone who has to do it every single day, that goes in and out and ensuring that your loan is handled correctly.
Mm-hmm. Yeah, so RESPA happens on the loan origination process and then on an ongoing basis in the servicing of the loan. It's a beginning, middle, and end process.
Mm-hmm.
Yeah, great.
Sure is.
Tell me about this.
We have people that ask us, how will they know where to make my payment? And so I just brought it up. We give the borrowers a welcome call, a welcome packet sent out to them. We like to give them a call first to let them know, A, that it's coming, because when people have just closed on a house or bought a house, there's a lot of junk mail that comes in the mail, and we don't want to be lost in that pile. We want to establish a relationship and tell them to be watching for our welcome packet that goes out. We send them a welcome letter, and we send them out in English and Spanish just to make sure we're hitting our target audience, that there's no question on how to make that payment. It comes out with their payment coupon, and then we have a little sheet that tells them 5 different payment options on how to get your payment on time. And all the paperwork heads out to them so they know where to make their payment, and if they have any questions, to give us a call.
One of the things our company does to make the process hassle-free for our investors, we usually originate the loan ourselves, and then we sell the existing mortgage note to an investor. So when the borrower borrows the money, they already know to pay August REI, and then when we sell the note to the client, the borrower doesn't even know that the note was sold. I mean, it's recorded of public record, but the borrower doesn't have to send their payment anywhere different. So to the borrower, it's business as usual. I just make my payment to August REI, and then August REI knows behind the scenes that the note was transferred from lender A to lender B.
You've definitely made it very easy for your investors. The borrowers are already dialed in and going ahead. This is what the borrower receives they receive a monthly statement just as a reminder to make their payment, that we received their payment, and these are the information that is required as per Dodd-Frank, that it be on their statement. Those information, breaking it down. I think on the next slide, David, actually included a top half of a statement I made up. So it includes all this information, and the bottom part that's not showing, which was a little long, just shows the payment being applied to the mortgage, how it's broken down between principal and interest.
That's awesome. One of the things that note investors, don't think about is they've often seen statements like this, and they only look at them from the eyes of being a borrower, right? Because they've all owned property or been a landlord, and they see the mortgage statement and they think, oh, this is a liability. But from the bank's standpoint, which is what we're talking about today, this is what your asset statement looks like, because that loan balance is your remaining asset, and the interest earned is your income. It's your gross profit on the deal. So it's pretty cool to flip the tables and to look at the same thing as not a liability, because every liability is someone else's asset.
Absolutely.
Yeah. Tell me about tax return.
I'm sorry, go ahead.
Yeah, so tell me about the tax reporting. The borrowers are paying you, and you're not going to pay the taxes on that interest. So how do you pass that tax liability on to the place where it's supposed to be?
Well, we generate a 1098 interest statement to the borrowers, and it actually has August REI on there, so it's not giving out the investor's, social security number or EIN number or their equity trust account number. I mean, it does, or uDirect account. It doesn't give any of that information out. But then from the lender comes a 1099 from August REI, and it lists the interest on there. And we report them all to the IRS, and they're sent out in the mail.
So the tax reporting on mortgage investing is very simple. The note servicing company does the accounting. They prepare a statement of what interest was earned, and they mail that interest statement to the investor. The investor gives that 1099 to their tax preparer, just like any other 1099, and it's reported as interest income on your tax return. It's a pretty simple process.
Yes, it is. Oh, this is the important part. Probably should have been the first slide. How do I receive money? And I think you kind of covered that. We do direct deposit payments out to our lenders. As soon as the funds are available, we're sending them out on a daily basis. And if it's to a self-directed IRA, we send those out too. If you flip to the next slide, I think There, we send it to the self-directed IRA monthly or quarterly, depending on how we are directed. It's made out as per regulations and includes a breakdown for each loan with principal and interest, depending on how your self-directed IRA wants their paperwork handled. We just make sure it's on every statement we send out.
And hopefully this next statement is worth the entire price of admission today, which was free. But when you send money to your self-directed IRA custodian, oftentimes they charge you a small administration fee if you've exceeded a certain number of deposits in a current year. By doing the deposits quarterly, so the borrower pays August REI, the servicer, they pay monthly, then August REI holds those payments for 3 months, and then they make 3 months of distributions at one time to your self-directed IRA. What that does is it reduces the number of transactions that are happening in your self-directed IRA, which makes your account transaction fees smaller or non-existent.
Absolutely, and we just do it as per directed. If you want them quarterly, and when someone has a larger portfolio, they might have 10, 15 notes that they're a participant on. So if we were sending a check for each time that we had funds coming in, it could really load up on the transaction fees.
Yeah, especially when you start buying note fractions, which is a service that we provide. If someone has maybe a 10% interest in an $80,000 note, so for $8,000 investment, they own 10% of that particular note. The interest on that is, it is what it is, but if you have to take a transaction fee for just that small interest deposit, it could significantly erode your transaction fees, which is why we do these, traditionally recommend them to be quarterly rather than monthly.
Exactly. Then we have online monitoring. They can look online to see where their payments are. And when we hold them quarterly, they won't show up because it's funds that are actually sent out. And if that's the case, we will make an Excel spreadsheet if someone wants to see who's paid, who hasn't paid, and where we are on the process.
I love going into my online lender portal and just seeing all those mortgage notes there and seeing the payment history. And it's just great proof of concept. The more I do this and the more success I have, there's a saying that confidence is repeat positive experience. So the more loans that I own and the more often those borrowers pay as agreed, the more confident I am that it makes sense. So we've got some great follow-up resources. We've just kind of scratched the surface of what is going on. We've got some great follow-up resources for the people who are listening to this webinar. All of these are free. So on my website, Hassle-Free-Cashflow-Investing.com, there's some great ebooks for free, including one by Kaaren Hall, 8 Best Kept Secrets on Investing with Your IRA. We've got a great video, nuts and bolts of being a private lender, that I recorded with professional mortgage investor Ken Gain, who's been one of my mentors for a very long time, one of the smartest note investors that I know. We really go through the nuts and bolts of making money as a private lender. There's another free video on our site that I recorded with Amy and Kaaren, as well as Amanda Hahn from Keystone CPA. And that is called Investing in Tax Strategies for Mortgage Note Investors. That's another great free resource that you can dig deeper into the subject. Again, this free white paper on being a private lender you can get on our website. That report is chock full of dense vocabulary words and made them easy so that investors can really understand the vocabulary of investing. If you're interested in mortgage note investment opportunities, meaning you'd like to actually use this information to make money, you can, number one, give me an email, david@hassle-free-cashflow-investing.com. We can make the process for you very simple and hassle-free. We do have mortgage notes available on an ongoing basis. You can give me a call, toll-free, 866-931-9149, or go to our website, hassle-free-cashflow-investing.com, click on the Investment Opportunities tab, fill out a very short 30-second questionnaire, and once you fill out that investor questionnaire, that will make sure that we send you mortgage notes as they come available. About 95% of our mortgage notes never get emailed to our database because there's an investor who's made it known that they're ready, willing, and able to buy a mortgage note, so it directly comes into our inventory and right out to a very specific investor. And so if you are interested in mortgage note investing, don't make it a secret. Let people know that you're interested, and you'll be front of the line to get opportunities as they come available. We love questions. So a lot of people ask questions on the webinar today in the webinar chat box, and we're going to be reviewing those in just a moment. But I really encourage you, if you've got a follow-up question that didn't get answered on today's webinar, or if you're watching a recording of this video after the fact, please send us an email. The email addresses are on the screen, and we can definitely respond to questions. Amy, I really appreciate your time today, and I really appreciate our relationship. Do you have any parting suggestions? You're a mortgage note investor yourself. Do you have any thoughts for our investor clients?
It's a great opportunity, and with the stock market doing what it's doing today, they need to be giving you a call and figuring out how to diversify their portfolio so they can retire someday.
Awesome.
With a great amount of money. Thank you for having me.
Thank you so much. We're going to stick around and do some question and answer for the benefit of the people who attended live today.